these targets are a compass. They're not a GPS, right? They sort of give us a way to structure our message about where we think the market is headed. And working through all the numbers, working through all the math helps you make sure that certain things make sense. And by the way, if your numbers aren't matching up with where the market is, maybe you're looking at the wrong numbers, right? You need to go back and sort of do that thinking. So it's all about sort of the framework and the process. Core to my belief of investing is there's not just one magic bullet. Right? There's not just one thing. It's not always valuation. It's not always sentiment. It's not always liquidity. It's not always earnings. It's not always fundamentals, right? I mean, it can be other things.
A very warm welcome to the On the Tape podcast. I'm Guy Adami, always joined by Danny Moses. Danny, how are you?
I'm good, Guy. How are you doing?
You look very good.
Oh, you look great.
And Dan Nathan. Dan, how are you?
You know how I'm doing. We've been together all
That's
week.
Good. That's an excellent point by you.
Sour.
By the way, you should stick around because we had a great conversation with Lori Calvasina. Lori's title, Dan, is
Head of Equity Strategy, U.S. Equity Strategy
Calvasina.
at RBC Capital Markets.
Lori is great.
She's the best.
She just raised her price target earlier this week in the S&P from 5350, I believe, to 5700, and we're going to discuss that and some other things with her. So stick around. Indulge me for a minute. Can you do that?
As we do.
We always.
I'm going to rattle off some towns in the United States that you might be interested in. Rough and Ready in California. That's an interesting name town, right? Mm-hmm. Santa Claus, Indiana is an interesting town. Here's a good one for you, Danny. Intercourse, Pennsylvania.
Why? What?
There's an actual town called Intercourse in Pennsylvania.
I can't even imagine where this
Toadsuck in Arkansas. I mean, it's crazy.
Okay.
Hazardville. I mean, that's sort of Why Not in North Carolina. Boring, Oregon.
Okay.
But there's a town in New Mexico that I think is fitting for what we're seeing today. And the name of that town is actually the name of an old game show. That's Truth or Consequences, New Mexico. And I bring that up because I think today we're seeing a lot of the truths play out, Danny Moses, and the consequences and how consequential all these truths have become for the market.
Really quickly, today being Thursday afternoon, the day of CPI, June CPI day.
Yep.
Yeah.
June CPI day. So is that near where that nuclear thing went off years
Probably.
ago? Okay. Anyway, so I feel like today, and it's not just because the market's down, and yes, I've been bearish, and yes, I've been wrong. That has nothing to do with it.
Are you doing that voice on purpose?
Yeah, I'm doing it as if
Okay.
it's my people that want to yell at me. But anyway, today is, to me, the most telling day. Why is that? You finally got basically 100% certainty that the Fed's going to cut in September, and what happened? You know, the realization of, I think it's what is driving the CPI lower. We've talked about this. So if you're going to have deflation or lack of inflation in goods and services, that means that certain companies that have been enjoying kind of the inflationary aspect and the spending of consumers are now going the other direction. Case in point, Delta Airlines, right? When you think about the services sector, right? They're not filling as many seats. That's one. Pepsi, which is goods and some services, but mostly goods. What's happening there? We can go through all of these names. And so you have to kind of do the trade-off of, okay, that's finally slowing. That's great. And now the Fed's going to go. But the Fed going 25 basis points in September is not going to change the course for what these companies have been doing. So in that regard, it's kind of a show me story now moment. And these companies have done well. And now are you willing to pay 21, 22, 23 times potential
or
earnings,
much
even
higher for a Walmart, for a Costco, right? And I think that's interesting when you talk about consumer discretionary. We've talked about Nike, which is down 32% on the year, Lulu, which is down 43% on the year. The list kind of goes on with some of those names. We know that Starbucks is down like 23% or so. So again, you know, the trade down has worked. That's why Walmart and Costco trade at nearly 25, 26 times and 30 times respectively. But again, air coming out of some of those names, and we're seeing massive rotations here today, Guy.
And by the way, short sellers, we saw the second quarter reports did very well.
Oddly enough, right? I mean, if you think about that, it's somewhat counterintuitive, but I saw that report as well. So, you know, people will just look at the S&P 500 and say, okay, the S&P was up this month or this quarter. There is no way that anybody playing things from the short side could have done well. But to your point, Danny, that's not exactly what happened. Quite the opposite. And I think, again, that sort of reinforces or galvanizes some of the things we talk about all the time. There's opportunities on the short side inside of a bull market, without question.
There is one other company I need to mention.
Well, go ahead.
Of course, Porter and Vinny were short it. Speaking of hitting something on the head, Helen of Troy. Okay,
let's talk about that for a second, because there's a lot going on there, and that's not a name that everybody knows about. The symbol is HELE.
Yeah.
It's a significantly sized company. They own things that everybody has heard of. If you go into a Walgreens or a CVS, and if you have to buy a thermometer or
thermos.
or thermos or a cuff for your blood pressure or a humidifier or a bronze shaver or Vicks, any of those things, that's under the Helen
And
of
they have
Troy.
some beauty products kind of lower end.
So please continue.
No, so obviously they missed earnings. Well, not obviously. They missed earnings badly, and they guided down, citing consumer spending, consumer discretion, all this stuff. But here's what's interesting. This is like if you're the CEO and you have to make decisions on your cash, what to do with it. They had a buyback in place since 2021, a $500 million buyback. Going into this last quarter, they had something like $250 million left on it. So they've been doing it obviously slowly. They bought $100 million worth of stock in the quarter, an average price of just over $99. So call it $100. You can see what the stock did. Basically went from straight down to $60. And the CEO is making, so why would you do that? If you, what are you trying to mask? Or are you showing confidence that, hey, listen, we bought our stock all the way down? To me, shouldn't have bought any if you knew how bad your quarter was going to be. And they had to know that it wasn't tracking well. So bad, golf course management, as we call it.
Well, think about that for a second. I mean, your point is well taken. If you're the CEO of a company, right, if you're in the C-suite, you should have some visibility as to how your company is doing, I would think.
Right.
If you have that visibility and understand what the ramifications are, if you're not doing as well as the prognosticators say, why would you be buying back that stock? It doesn't make a lot of sense. The flip side of the coin is maybe they don't have the visibility, or maybe they have the visibility, but they're doing it regardless to sort of show that strength. No matter basically any scenario you give for this very specific subject and topic and company is a bad one.
Yeah, I'll just say this. I think a lot of these C-level suite people of publicly traded companies, they have no idea how the market is going to react to the news that they're giving. And the stock was trading at a 52-week low, trading at about 9-10 times earnings. Now, earnings expected to be down this year, I think mid-teens or something year over year, despite revenues being sort of flattish. So again, I'll just say this. I mean, in all the years that we've been in the markets, I've always been surprised at just how a lot of CEOs have absolutely no clue, upside or downside, how the market's going to react.
You bring up a great point, and we're going to talk about the bank earnings in a second. What did Jamie Dimon say a couple months ago? He's not buying back his stock not because bad things are happening, because he knows that 2 times book is not where you want to start using your ammo. And so I guess the point is that what do you think that the market would say? Yeah, but they bought back stocks. That was good. No, you have $16 million in cash on your balance sheet at the end of the quarter. By the way, they're cash flow positive. They're not going out of business. But the point is they spent it all on buying back their stock.
But again, it speaks, and that's, again, a very specific point for a very specific company. But, we've talked about these consumer-facing companies, Dan, and over again over the last few months, you're hearing some very cautious commentary out of all of these companies. The last was Pepsi. Again, we're doing this on Thursday. We just heard it out of Pepsi-Cola. And you're hearing it from a swath of companies across a swath of industries. And at a certain point, again, it's that truth of consequences thing. The truth is inflation is slowing without question. We've talked about that for a while. The consequences, though, are the economy is probably slowing as well. And be careful what you wish for in the form of a rate cut, because historically, ex-1995, that's when the market does their worst.
Yeah, and we say this all the time, that valuation is not a good timing tool as it relates to the market. But yesterday, on Wednesday, Bank of America downgraded MasterCard and Visa, and it kind of plays into this narrative, what we're seeing. So if the consumer's weakening, right, and this is being confirmed by some of these retail and discretionary sort of companies, then you would expect to see lower transactions on a MasterCard and Visa. And if you start being focused on valuations again, well, MasterCard trades at 30 times an expected earnings growth of about 15%, right? Visa trades at about 26.5 times this year versus 13%. So they're trading at a PE to growth, or a PEG, of 2. Okay, now that might not be so expensive for MasterCard and Visa relative to themselves, but it's expensive relative to, let's say, somewhat to their trailing earnings.
As I've been saying, what you should fear is, as an investor, is when rates start moving lower and the market moves lower, because that would be the ultimate, I think moment where it's like, okay, I can no longer use that as my factor for investing. Oh, rates lower, buy the S&P. It's the reason that rates are moving lower. And I was at the 22V research conference yesterday that Dennis DeBuscher put on, and we've had him on the tape. He's going to come on here in a few weeks, and he had some really interesting people presenting. One of them was Ernie Tedeschi, I'll probably butcher his name, who's worked in the White House, and he's a fellow down at Georgetown, I think, and one of your guys,
Soros
University.
Center.
Soros Center. Yeah, so very smart guy. And he was talking about the fact that we are at full employment. And that's not a negative thing, except that it has one direction to go. And he's confirming it based on all the things that he's seen. And so you have these weird correlations, kind of like the inverted yield curve, where certain things are supposed to happen and then they don't. He says everything's going to be out of sequence in terms of how you're going to see things. And I think that was really interesting.
You know, it's interesting. Remember we had David Rosenberg from Rosenberg Research, I want to say like a year ago, and he gave us some stat, and I've been trying to find it. I'm going to hit Rosie and try to get it. He said when the unemployment rate rises 50 basis points from a low.
Yeah, it's that rule.
It's like a probability of recession becomes very high. And again, we've seen this recession that the stock market was pricing in 2022 pushed out. At least 2 years now. And so it'll be interesting. Guy, you've been saying that you think unemployment has the ability to go up to, I don't know, 4.5%.
At least. I think higher than that. And again, California, and we've talked about this, if it were its own economy, it would be, I believe, the 5th largest economy in the world. I mention that because the unemployment rate for the state of California is just north of 5%.
Yeah.
And again, you know, one of these things that typically leads the broader United States is, in fact, what's going on in California. Now, people will push back and say, what are you talking about? Haven't you seen what's going on in California? It's its own. They have their own problems. A lot of it's political. I get it. You know what? The fact remains that you're seeing unemployment tick up in a meaningful way there. And I think it's just a matter of time before it happens.
I saw something earlier in the
broader country.
Yeah, I saw something earlier in the week that I thought was really interesting. So Intuit, this is a $176 billion market cap company that said they're going to lay off 10% of the workforce. That's about 18,000. Now, maybe in the grand scheme of things, that's not such a big deal. But let me tell you the reason why they stated, okay? They said because of their investment in generative AI. So they didn't say that these cuts are one and done. They said they're going to replace a lot of them with employees. Now think about it this way, that probably much less employees than the 1,800, but they're going to be a lot more expensive than the other ones here. So again, you might see some of these companies dealing with margin pressure here, right? And so thus you would expect lower valuations for some of these names.
They can also use that as an excuse now, because if you say AI, it cushions the blow a little bit, because what you're saying would be a positive, which, listen, numbers have come through for some of these semi companies. Orders are there, right? But at some point, and I think Goldman Sachs is, pointed out that I think between the 4 big hyperscalers, $357 billion has been spent. And they're very concerned. To your point, that stuff has to get down to the market level.
This is also a consumer-facing company, right? When you think about it, that trades at 37 times earnings this year, right? That are supposed to, they're supposed to be up like double digits, maybe low teens or something like that. So again, and trades to 32 times next, and you're going to see a deceleration in earnings. So again, valuation, not a good timing tool, but when you start to see some of these other dynamics, it doesn't kind of shape up particularly well.
I saw an interesting thing happen today. Oh, yes. You know what that's from? Remember in Godfather 2,
yes.
They're sitting in Cuba, the birthday party,
yes.
up on the patio,
yes.
and Michael's sitting there as his legs crossed.
With Hyman Roth.
Yeah. And he goes on to talk about what he saw that was really interesting in the morning, and it gave him some consternation about whether or not he was going to make his investment in Cuba. Yeah. This being Michael Corleone, Danny.
He basically says, if I have a bag with $2 million by the morning, I know I have a partner.
If I don't have it, I know I don't. Yeah. I know. That's Hyman Roth.
Yeah.
Fredo. Anyway, keep going.
But I did see something interesting this morning being Thursday morning. Dollar yen was approaching 162, Danny. I think it was 161.60 or so.
The intervention, what a show! Sorry, go ahead. Yeah.
Are you going to sing now?
No, I was. That was the.
That's from
History
not
of
the
World.
Intervention. That's History of the World.
I know. I changed
that's
the word.
the not the Intervention. The
Inquisition.
The Inquisition.
Please continue. Please continue.
So the CPI number came out. I think 15 minutes later, dollar yen went from 161.50, let's just say, down to 157.5. I've been in this world a long time. I have not seen a move that quickly of that magnitude. So clearly, and I'm not saying anything nefarious happened, but there was some sort of
intervention.
Thank you. Yeah, that went on clearly, and whatever shorts were in the yen got pretty squeezed pretty hard. With all that said, I mean, there's so many things happening now. I mean, if you just look around the globe and see. So when you see 2-3 standard deviation moves like that, it's got to give you some at least some cause for concern.
Regardless of what caused it, whether it's actually the Japanese government and the Bank of Japan in there buying yen, or it's just a quick knee-jerk reaction to a lower CPI and dollar weakening.
that was something more than that. Yes.
So whatever it is, people use that as inputs to buy securities. People use that as leverage vehicles, whatever it might be. That should scare you from a liquidity perspective, that you can move a major currency like that 2 to 3% in a matter of seconds.
Minutes,
so
yeah,
that's the part I think that I take away. We've been talking about the fragility of markets in general and the lack of depth, right, in terms of what's in these things. So
I'll just make this point. If you find this conversation about the yen interesting, go to your chart and pull it up, okay? Because back in late April, there was a tremendous amount of volatility. There was a huge reversal day. Okay?
Yeah, but they intervened. The Bank of Japan intervened twice over the course of a few days.
Yeah,
absolutely.
And so there was a 4% intraday reversal, which is kind of interesting because today we're just talking about from the highs to the lows, about 3% or so. But in a currency, that's massive, to your point. It speaks to maybe just a one-sided buyer or seller, right? In this case, it would be
it's not Zimbabwe.
Right. And so there was a week of extreme volatility, and then it got back towards its highs. And
if you don't think that can happen in oil and all other
products, what's the knock-on effect? Just explain this to the listener a little bit, okay? Because again, this was a carry trade, right? People were selling.
Well, the knock-on effect
to fund higher yielding things.
So I don't think anything's going to blow up because of it. So the knock-on effect could be, okay, you had a firm, as Guy's point, that was short, that got taken out of their position, that was stopped, whatever. To me, the bigger point is that if it is an intervention, and if the yen continues to weaken and re-weakens back to that level, that's the faith in the central bank. That's the problem, Dan, to me, and that's why it's worth watching. No other reason really than that, in my opinion. And the markets just aren't as liquid as they've been.
Danny hit the nail on the head. They've used their bullets. It was clear that they were waiting for this CPI report to come out. They used the ability for, again, our rates to go lower as sort of the catalyst to intervene in a pretty major way. We're going to see what it was, I think, in the next.
And they wouldn't comment, which means they did it.
Which means they did it over the next couple days. But I think the broader point and the more important point is how long will it last? Because if this time next week or by early August, we're right back to 162, they basically, they've shot the bullets that they probably have, and then we're going to be talking about that again. So we'll see. I mean, today is a fascinating day, again, for a myriad of different reasons, but I would have been remiss not to bring that up because that's just something, Dan, you don't see all that often.
Yeah, no doubt. I mean, can we kind of bring it back to the stock market for a second here? Because, Guy, I think you would agree this is something that we don't see quite often, but it's going to bring you back to the March-April period, the reversal in Nvidia. And so you've talked about this a bunch. And so from the highs of March 8th to its lows, I think it was kind of mid to late April, the stock sold off 22%. From the lows in mid-April, the stock went up to June 20th, Guy. It had a big reversal day there. But the stock had rallied 84%. This is a $3 trillion market cap. So as we discuss this today, the stock's down about 5% for really no reason. I mean, we're seeing a huge reversal in the Mag 7 in general. I'm just going to run through this a little bit. Apple is down almost 2.5%. Google's down almost 3%. Amazon's down 3%. Meta's down 4.5%, and Microsoft is down 2.5%, and Tesla, and we're going to talk about this one in particular, down over 7%, right? So when you think about these reversals, we can't put our finger on any specific news.
Sentiment.
Well, it's sentiment. Don't you want to talk about that, Danny, a little bit?
No, but it is the sentiment.
No, let's talk about it. So
yeah.
It was all in on one theme, and it was concentrated in about 7 to 10 names, Guy.
Without question. And, you brought up, let's just look at it through the technical lens. And I'm glad you brought up March 8th because it was a Friday. We talked about it. We talked about it on a market call. We talked about it on the tape. We said the engulfing pattern that you saw that day in Nvidia, that Friday, March 8th, where the stock made a new all-time high, closed below the prior day's low, is something, again, you don't see all that often. And it's something you have to absolutely watch over the next couple of weeks. Nvidia traded sideways over the next week and a half or 2 weeks. It sort of tried to get back to that prior high, failed, and then by the middle of April, the stock was down 24%. June 20th, same thing. The stock traded up to 140.76, closed on the lows that day. That close was below the prior day's low, the same pattern exactly. As we're sitting here, it's trading either side of $129, and I think we're setting up for the same type of thing, a move subsequently down to probably the low 100s, which percentage-wise makes a lot of sense. Now, I think I know what that means for the broader market, but let's see. However, quickly, what you didn't see on March 8th or June 20th for that matter was an engulfing pattern in the S&P 500. You're seeing that today. Today, Thursday, the S&P 500 made a new all-time high of 56.42 and change. As we're sitting here now, it's either side of basically 55.90. So something to absolutely watch because, again, these don't come around that often.
You remember the movie Vision Quest?
Sure.
Reversal.
Movie. Matthew
you get a
Modine.
reversal. You get a reversal. You get points for that. Anyway.
3 points, I
I
believe.
want to
for
comment
reversal.
on it. I think that's with an escape. I don't remember.
I don't know.
Who knows? We're going to get added on that one. Anyway, so when you look at Nvidia, there has been a great trader of the stock, which has been the CEO, right? Jensen, and you bring up March 8th, which is interesting. He filed his 10b5-1. Again, people who filed his 10b5-1 in like March 13th. You got to wait 90 days. On the 90th day, 91st day, he starts selling stock. What's his 10b5-1 plan? You don't know what it is. It probably says sell 120,000 shares every day that you can, okay? He has literally sold shares literally every trading day.
Do you blame him?
No, not at all. So this 6 million share program,
Yeah.
he's about 2 million shares in from literally in less than a month. So I just want to point that out. No one cares about that stuff when a stock's going up. But I want to give Citi credit for this. You guys probably talked about this on Market Call, and I apologize if I'm being redundant here. But Citi came out earlier in the week and says, quote, for all the optimism over stocks, particularly those exposed to AI, sentiment towards AI-exposed equities is the strongest since 2019. I didn't know you had AI-exposed equities in 2019, but that's just me. And free cash flow, the bulk of those is forecast to outstrip analyst expectations. Readings like this typically suggest significantly more volatility is on the way. Anyway, so they basically said time to take chips off the table. So to Dan's point, you cannot price sentiment. No one asks questions when the stocks are up 3% a day for 10 straight days. It's like, why is the stock down? So it could rebound, you know what? And it probably will. And it's been a buy the dip moment every time. Maybe this isn't that. I don't know. But again, where is the buy point for these stocks that you mentioned? You mentioned a bunch of consumer stocks today. That's the problem, is knowing.
Well, listen, as far as Jensen's concerned, his holdings are worth over $100 billion, Danny. So the idea that he is selling stock in whatever plan that you want to say, with the stock up thousands of % over the last 5 years, it makes a little sense. He's been at this company for
it isn't the point that he shouldn't be able
to
to sell. It's my point that whatever 10b5-1 that he has orchestrated, it's selling every single day. So my point is that people should care that he's.
Why not, Danny? There's been insatiable buying interest.
There's nothing illegal. You're misreading my.
No, I know.
He could say you could have a 10b5-1. You're like, I'm going to sell some at 130, 140, $150, 160, but that's not what it is. That's all my point is, Dan.
No, I get that. So
by the way, there was a Goldman Sachs piece earlier this week. I think there was a Sequoia piece earlier this week, and Roger McNamee spoke about it on Squawk on the Street, I believe, on Tuesday of this week, saying, there are some firms now coming to the realization or the conclusion that maybe there's a little too much hype in this AI trade, and that, you're not going to get the commensurate returns on the back end, and maybe the monetization that's required is not going to be there. And, I think more and more people are seemingly coming up with that thesis. So something we've talked about, and it's something that more and more people that I admire and respect are talking about.
Well, we're going to see that. Okay, so if you look at Nvidia, that doesn't report, I think, until like August 23rd, but 40% of their revenues come from, the names. It comes from Microsoft, Amazon, Google, and Meta, right? So if these companies report lower than expected CapEx, right, and they give Q3 guidance that is, in line or slightly below the street, well, then Nvidia's got more room to the downside, right? Let's just be clear on that. And the other point I'll just say is that, and we've highlighted this on a couple of occasions, from the highs in July of 2023 to the lows of October, the S&P sold off 11% or so. A lot of these names that I just referenced were down at least mid-teens, some higher. So when you talk about sentiment, Danny, year over year, right, it's much higher, right? And the risks are much greater because those Mag 7 or so, like let's call it X Tesla, have gained what, $2 trillion, $3 trillion in market cap since then.
Before we get to a couple of other things I want to talk about, we need to bring up your favorite, my favorite.
Gold.
Thank you. I knew you'd come around at some point.
I was waiting. You went to California earlier in this conversation. I thought for sure Gold Rush was
going
coming.
to California with an aching in my heart for you Led Zeppelin fans out there. But the gold market, again, we're seeing it in silver as well. But for the first time in a while, if you look at the GDX, the gold mining ETF, that's probably a 2-year highs here, and I think it's going to continue to go higher. And as many things that I've gotten wrong, I mean, this is one I think we've collectively gotten right. Gold is on its horse, silver on its horse. The miners are starting to participate. And I think what we're seeing, again, the reason I brought up the yen and those types of things, they're all catalysts to me for people to get into the gold market. And what I find interesting, Dan, before you go, one would have thought Bitcoin would have rallied given the dramatic sell-off we've seen over the last couple of weeks. We're really not seeing that, at least yet, Danny Moses.
Yeah, I won't comment on Bitcoin crypto, but that's kind of its own animal, and there's other supply-demand economics going on there. But with gold in particular, and I believe I got to sit on Market Call last week with Carter Worth when we were on there with him, Dan, and you guys brought up gold, and it was at an inflection point, and it wasn't a pair of twos. Carter was like, this is basing, and it's going to go higher, and he was right. And this is why we've been saying gold can win in a lot of outcomes, especially if you're dovish, you think the Fed's going to come. But I think it's more than that. I think gold now represents central bank incompetence, potentially. I think it represents, because if you get to
why
the
do you
point,
think the central bank here in the U.S. Federal Reserve's been incompetent over the last few years?
No, I'm saying that if it becomes a time that the people believe that that they can't effectuate or do the things they used to in the past, there's going to be a real crisis of confidence. What I'm saying is gold has kind of replaced that. And to your point about Bitcoin, it has replaced it, at least temporarily, as the go-to security. And I believe, Guy, it's still very under-owned on the institutional level. Bitcoin had its move. Crypto did on the under-owning of institutionals, the ability to own it through these ETFs, and they got their ownership levels. I don't think gold, while there's been more vehicles to trade gold forever, I don't think it's really there yet. So I think it's really interesting. And it incorporates the other aspect, which is the geopolitical risks that are out there in general. And so to me, we've talked about this every time it's been weak. We say buy the dip, or no, we're not selling here, trimming. I think it's got more.
Well, and I'll say yes, I do think they've been incompetent. Now, through the lens of the stock market, they've been heroes. Through most people living in this country, they've been the villains. I mean, because if you think about it, when they lowered rates, the only people that were really getting helped by lower rates were people that own stuff and the wealthy. The middle and the lower class were getting squeezed, and that's just factually true. On the way up, when they were begging for inflation, people were like, why do you want begging for something that's going to clearly hurt us? Well, they got it, weren't able to control it. Now, 20% cumulatively later, they're starting to see basically the effects of their rate hikes, and people are still getting hurt, because if they were the geniuses that a lot of people think they would, Biden's approval rating wouldn't be 32% on the economy. It would be 78% or 68% on the economy.
I mean, I have a slightly different view here. I mean, if you think about when Powell came in 2017, he started raising interest rates, right? And so he was set to do that. He wanted to normalize interest rates. And then all of a sudden we have, this black swan event. The only black swan event that I can remember for the most part in my career, other than maybe 9/11.
Well, that was, you're talking about COVID.
But that's what, COVID.
Okay, but you were talking about 17 and COVID are two
No, but they were raising interest rates.
Right.
Okay.
And he stopped because the stock market spooked him.
Okay.
And because the administration browbeat him.
So that was late 2018.
Yeah, it was October 18. Yeah.
So early, in 2020, they lower interest rates to avoid, the mother of all credit crises and that sort of thing. And so again, we had these supply chains that got all out of whack post-COVID, 2022. So we saw inflation starting to pick up. That would have happened in any scenario, right? So maybe the only mistake that they've made is they were literally just, 6 months too late to recognize what inflation was going to do. And we had CPI above 9%. And this was after, obviously, Ukraine was invaded by Russia. And so, listen, I think that if they're able to bring inflation down to their 2% target and they avoid a recession, I mean, I get your point, Guy, about a low-end consumer here, how they've gotten it both ways, but they might be able to have nailed the landing.
Maybe.
That's all I'm saying.
Let me just,
and that doesn't make them villains.
Let me just come in, and I think I'm kind of in the middle of where you guys are here, is that nobody likes pain, and this market has been a moral hazard issue since Bernanke came in 2008 and tried to clean up the situation. I don't fault any necessarily of these central bankers as, quote, they're obviously all very intelligent, whatever, but they become prisoner to the markets, and they have to do things. And Ben Bernanke, we used to call his precious, like in Lord of the Rings, was the stock market.
Yeah.
And he would react literally.
Gollum thing.
Yeah, he would literally react.
He was about as tall as Gollum, I think.
He would react.
I think he's a little guy.
Right, now he's firmly employed at Citadel, obviously. But he would react on a Friday to a bad site with some Monday morning program that would come out. He basically became an indentured servant, to the stock market. Okay. And all that stuff that we've done since that exact moment. You can say inflation this, inflation that. We are not paying attention to the bigger issue, which is the amount of crap and debt and the stuff that's on the Federal Reserve balance sheet that is sitting there. It's still $7.2 trillion. And we can talk about, he's just softly. I think he's done a fine job actually in the last couple of years, Powell, saying I don't envy his position because when the stock market turns, they're going to say you waited too long to cut rates and all this. So I just think what I'm saying from a gold perspective is maybe incompetent is the wrong word. It's a lack of faith that they can control the narrative or control the outcomes of things with another new program guy of a BTFP like
uneasy lies the head that wears the crown.
Can I make one point because you pushed back about that 2018 where the S&P sold off
19.9%.
19
from Halloween until Christmas.
So they stopped raising. They got a bit easier. And when I think about that, and Guy, you made this point on many occasions here, is the wealth effect that's created by the stock market and created by the housing market. And I think that was one of the reasons why you get a little easier. So I don't think it's as clear cut as that the S&P sold off 20% in a straight line in 2.5 months. You know what I mean? I think that they did probably something where they shifted the focus from all the downside fears that people had about global growth and the like. And if that's what I think that was about, well, they had a stock market that started going up again and housing that started going up again.
No, and I think I think Danny married our two sort of diametrically opposed positions very nicely. Basel III sounds like a good pizzeria, right? In like New Rochelle. Right. Like, where are you going to? Let's go to Basel III and get a slice. Yeah. But that's not what it is.
No, it's not.
No, it's not.
It's the regulations for the banks. And I'll give Meredith Whitney credit. She said this 18 months ago. She's like, watch. They're going to soften their stance on the U.S. banks.
You've been talking about
this. She's been talking about it. Yes, and I've been talking about it. And you guys have asked me many times. I cannot, not that you don't understand the reason the banks are so strong. I'm telling you, there's an underpinning of the regulatory relief in some form or fashion that you're going to need the banks, and it is what it is. So I don't short the banks necessarily for that reason. There may be other reasons to short them, but that's obviously been coming. And so, we got through the stress test. We know the big banks are, quote, fine. And so Basel obviously is they're going to delay the implementation, and rest assured, if there is more volatility in the financial markets, that they're not going to put any pressure on the banks to adopt these new regulations. And so
I have to make a correction here. So Ben Bernanke was 5 feet 8 inches. Okay, that's how tall he is.
According to
the internet.
I think the shirt you're wearing would fit
Gemini. Yeah. And then I have to put we got to search for Janet Yellen here. She's 5'2". She's 5'3" when she's wearing heels.
Anyway. I'd say as much as I dislike Ben Bernanke, I think I dislike her more. I don't know what it is.
What are you doing getting him going on?
No. I woke up. It's like I say all the time. It's like Damone. I woke up in such a good mood.
Right.
There are a lot of things.
You
to like
know
here.
Damone. I stick up for him. Damone's an asshole. You know Damone.
I think today, just to sort of summarize before we talk to Lori, I do think there's a lot to sort of take in today. I mean, we started it by talking about truth or consequences. I think we know some of the truths, but I don't think we understand some of the consequences. And I think before our eyes, you're starting to see for the first time in a while some shifts, some dislocations that we haven't seen.
I got to make one more comment.
Please.
Because it's been ignored because it's not as big of an issue as it was in 2005 and 6, and that's housing in general. And the amount of listings that are coming on in certain states is record levels at this point. People are going to charge. So you're getting to the point where golden handcuffs are outweighed by the need for cash. There was an article this morning in the Wall Street Journal about insurance companies that are basically sticking it to the states. Like, well, we're not coming in your state because the catastrophes, and we all know the hurricanes and stuff. And I know, Guy, you know this, but insurance prices for homeowners are not in the CPI.
No.
They're not calculated that way. Rental insurance is, but not homeowners. So my point is this. You can look at all the numbers you want, CPI coming down, but the true impact on the consumer is the true impact to the consumer. So stop obsessing on every economic data point. Listen to what these companies are saying, right? And Dan, your point, and you keep bringing it up, and you're right on, is the Costco's and the Walmart's going to get to a point where you can't hold your nose anymore and buy them, and they will soon lap the impact of the market share gains that they've made. But the consumer, think about what Pepsi was saying. Pepsi was saying things like, people normally buy 10 packs of chips. They're not doing it. They're buying 1 pack of chips. Those are the behavioral changes that not going to see in the CPI necessarily yet. But again, because they're paying more in insurance. Homeowners insurance is a big problem. So we'll put that in the show notes. Read this article in the Wall Street Journal. And I always talk about this to people that listen to the podcast. If you can find a sector to talk about from a stock perspective, and then a sector to talk about that helps you personally from a perspective to understand what is going on, read that insurance, because you don't have to own Chubb and own these or short and long Allstate and stuff, but understand why and what's happening in where you live, and make you a smarter person and help you. Anyway.
I think they changed the way they
calculate
CPI in the early 1980s.
Are you D90?
You find that, man.
You find that, man.
Yeah.
You find that. Yeah, they changed it.
It was a
please,
one-armed man.
Go ahead. You go.
And the calculations that I've read, that if we were to still do it the same way we did some 42 or so years ago, the inflation rate would be much significant. When I say significantly higher, more than double where we are now, which is why, to your point, you can talk about CPI all you want. The reality is people are feeling the pain.
Yeah. Before we get out of here, we got to talk about we alluded to Tesla and its price performance.
1 minute on Tesla.
Why.
Go, Dan.
So really quickly. So, it was earlier this morning. This was actually one stock that was outperforming the Mag 7. This is a company that its highs, I think the start of the day from its lows back in April, had gained 90%. Think about that. And if you look at the chart, it went up from 200 to 264 in a straight line over the last 2 weeks. So the headline was that robotaxi event for August 8th had been pushed to October, not a specific date in October. And when you think about this, I just find it really curious. So the stock reversed. It's down about 7% right now. I find it curious because this was one of those headlines back in April when Q1 deliveries were really bad, when margins were really, coming in pretty hard. Elon, they announced this on April 5th. Elon, traveled to China. Do you remember he visited the vice premier and said that he got approval for full self-driving, and the stock kind of took off. So when you see these sorts of headlines, Danny, first and foremost, is this price manipulation? You know what I mean, of the stock? Well, it's coming up with BS reasons, you know what I mean, to squeeze shorts.
So I've been on this for years, obviously, ridden this thing up, down, sideways, under the viewpoint that it's an auto company. People would see through the bullshit that there's ever going to be anything else. Post that quarter, traveling to China, autonomous vehicles, robotaxis, all this stuff. Give him credit for being an incredible PR person. Again, P.T. Barnum, that he changed the narrative completely to the point where analysts came back out, raised their targets based upon the fact that it's not an auto company. He has completely convinced them, except every time they report earnings, or most times, it's the point of reconciliation of what is this thing exactly and where. So if he was selling stock, Dan, into it, but I've sat there and taken it, and I didn't take enough off the table, admittedly, when it was 150, 160, but I'm certainly not covering at these levels. I believe it will work its way back down again. And so, again, I feel for the people that are chasing it. And if you know me, I don't victory lap on anything, and certainly not on Twitter, and I can take the hate stuff on Twitter. I'm a fundamental person. That's how I approach the markets, and I'll ride the thing out.
All right, really quickly, in April, when you couldn't give the stock away at $140, okay, it was trading on its vehicle sales and deliveries, right? And the margin pressure that it had and the competition and the like, okay? So when it started going back up, investors started thinking about Optimus. They started thinking about energy storage. They started thinking about full self-driving, and they started thinking about robotaxi. All of those things right now are a pipe dream other than the potential for full self-driving. And by the way, the NTSHB or whatever the heck it is has basically said, they basically said that they need to call it supervised full self-driving.
No one cares, and he doesn't
now, with the stock up 85%, guy, it's being valued on all that other stuff. And I want to make one last point. You remember about a month ago when Elon said that Tesla was diverting the delivery of H100s from
the $500
Nvidia?
million order?
And I basically said at the time, I said, if they're going to build this robotaxi, wouldn't you think they need these high-end GPUs? Because seriously, these things, there is artificial intelligence that goes into this. They are not using LiDAR, okay, for their robotaxis. They're using an AI-generated viewing of what's around them. Guy, you're just laughing at me.
No, because before a guy speaks,
this is really important. So if he's diverting all of the tens of thousands of these H100s over to XAI to train Grok, which is a total piece of shit as far as a large language model, I just think there's some funny stuff going on over there in between all of the Musk
Guy
companies.
refused to play the Tesla stock game, and he's been right to not get the brain damage from it. So you've been adamant. You're like, yeah, I don't like it, but I'm not messing around with this thing here. Because
I think there are levels. We've talked about it. I thought
because you're a street guy, you sense when the bullshit's happening, not to fight.
No doubt. But we also I would say it's 3 weeks ago or so. We had a conversation on Fast Money. Melissa Lee said there are 2 analyst calls today. I think the stock was trading about 170 or so, Tesla. One has a $200 price target on it, and one has a $125 price target. What do you think? And I said to her, oddly enough, and I'm not trying to sort of duck this question, but I think they're both going to wind up being right. I said, we've seen bounces in the stock before. I think it could easily trade to 200 before it trades back lower to 125. So, yeah, I thought 200 was, but I didn't think 250. I mean, I did not think the stock was going to go up 90% from basically trough to peak.
All right. Well, I'm sure this has taken the meme playbook that kind of made it in, right? It made it into the last bit of kind of meme stock, AI thing, whatever. People calling your stock, don't lend it out, put limit orders in up high on a sell point so that they can't take, all that dumb stuff that you manipulate it. But I don't think the real institutions, Dan, are messing around in it right now.
No, I mean,
all.
but think this goes back to 2021 with all the Dogecoin crap, and he loves the memes on Twitter. You know what I mean? Like it's just how many other CEOs of $500 billion market cap companies, and by the way, it's a $700 billion market cap company, spend as much time as he does on Twitter retweeting memes and stuff. So that's it.
Anyway,
for you folks in Rough and Ready, California, Ding Dong, Texas, this is my personal favorite. Blue Ball, Delaware. Oh, I mean, that's a rough name.
Is that what
for
they're
a
calling
town.
them now?
There's a town in Delaware. Stick around.
He's giving us all Blue Ball.
Because Lori Calvasina is going to join us on the other side. Welcome back to the On the Tape podcast. As teased earlier in the show, we're sitting down with Lori Calvasina for at least the third time, if not fourth. Of course, she's the head of U.S. equity strategy at RBC Capital Markets. How are you?
I'm great. It's great to be back.
Well, it's great having you back. You and I were on CNBC's Fast Money earlier this week. We had the opportunity to sit next to each other. We had a great conversation. Dan was not there. Dan was getting his hair. No, I'll tell you what Dan was doing.
I was
Dan was at the New York Stock Exchange.
NYSE.
What were you doing?
I was with the trophy for the World Championship Celtics, and we had a little fun with that thing. Wick Rosbeck, who is the lead owner of the Celtics and a friend, he went on the show, and he was talking about, this is the first conversation that broke with Scott Wapner since they announced that they were selling the Celtics after they won the championship. So we spent some time with the trophy. We brought that thing up to Rick Heitzman's office. Then we went to the Polo Bar, and it was amazing. So it was really cool.
Very
so
80s.
That's why I was not on.
That's the
Fast Money with
the
you,
Lawrence
Lori.
O'Brien Trophy.
Correct, and we
believe.
just call it Larry. We just brought Larry all over the place. We put it right on the bar in Polo, and then we put it
Larry.
right in the middle of the table we were sitting at. Probably 50 people came up to take pictures of, and half of them are probably Knicks fans.
Now, I have said a number of times that there's certain people, when they go on the network, you should turn the volume up. And that's just me talking. And people typically don't listen to me. Lori Calvasina happens to be one of those people. But recently, since your last appearance with us in December, both you and Halima Croft were named one of the 100 most influential women in finance. That's heavy shit. I mean, that's fantastic, right or wrong?
No, it was a really great honor, and honestly, it was really exciting to be able to make it with Halima. I mean, she's just amazing.
Both extraordinarily deserve it of it, without question. So it's great that you're here. And listen, you were here in December. We tried to push back on you because, you've been optimistic and you've been right. Obviously, Dan and I have been anything but. A lot has changed. A lot of the things that you talked about with us in December have actually come to fruition. Recently, you raised your price target, I believe, from 5,300 to 5,700. I might be off by a couple S&P points. And we want to talk about sort of the process and those things. But again, since you've been here last 6-7 months, what has sort of stuck out to you?
So I think first of all, I would just say it felt like a very long first half of the year. We kind of got to mid-year, and I kept describing myself as sort of a tired bull, and I've amended that a little bit. But I think just so much happened in the first half of the year, and the market moved up, but it just didn't quite feel so good. That's probably the big thing.
Was it because of the breadth in some ways, or no?
I think it was. I think if I look back to April and we had that pullback, right, it was only about 5.5%. It just didn't quite feel like enough. And people didn't necessarily feel great when you got to the bottom of that 5.5%. I think a lot of people were looking for a pullback to happen and wanted it and thought it would be healthy, and then you got it, and somehow even that just didn't feel rewarding. So I just think it was a tough first half for a lot of people.
How do you feel, again, we're obviously just started the second half. I know that you had a second half outlook, and we're going to get to some of that. But, the S&P 500 is up, nearly 18% on the year. The NASDAQ 100 is up 22.5% on the year. The equal weight S&P, and this goes back to breadth, is up, less than 5% or so. And when you think of that outperformance, Guy and I have been talking about this a bit of late. It's like a lot of those gains are coming from multiple expansion, right? And we know that the S&P is trading, well above the 5 and 10-year averages. How do you think about that? Like, put in context some other periods where you've just seen investors willing to pay much higher multiples because of some narrative that's going on in the market.
Yeah, it's a great question. And I feel like I take a lot of comfort in the math. And so we have this valuation model, and it's a trailing PE model, not a forward PE model. That annoys a lot of people. But I just happen to have good data on average trailing PE going back to actually the 30s. And our model goes back to 1962. And, to answer your question about other periods, what I found is that if I look at that particular data set and I measure correlations with different macro variables in the post-COVID environment, it's actually inflation that's got the most robust inverse correlation. Interest rates also have an inverse correlation, but it's not as powerful as inflation. So guess when else that happened? The 70s. And it makes sense. So just understanding, yes, the multiple is a little bit higher than people have, thought it should be, wanted it to be, but it's because it's something different driving it. And it does kind of make sense when you go back and look at past inflationary environments. At least I understand why it's happened, right? But I will tell you what's been interesting, and I've been struggling with a little bit, frankly, the last few months, is that I spent much of the last 2 years, year and a half since we put that model out there saying, hey, multiples can be higher than most people think. And because, we've looked at longer periods of history, we've looked at, not just rates, but we've looked at inflation as well, and we've looked at the trailing PE. But now we've actually gotten to a point where even my valuation model is telling us that we're a little bit overvalued. And I had to do some thinking about that, in kind of like the May, June timeframe. What finally sorted it out in my head was that I decided, it's too early to do a 2025 target, but I'm just going to run all the numbers and see what it shows me. And when I did that, it actually showed me that if I sort of take assumptions for further rate reductions, declines on the 10-year, more moderation in inflation, put that in the 2025 outlook, use the earnings data. Okay, well, I can justify an S&P 500 around, say, 6,100 next year. And I started thinking about that, and I said, okay, this just happens sometimes, right? Markets can be expensive for a while. We don't always just sit at those averages. We don't always just sit at fair value. And, I had other things that were telling me the market could maybe go a little bit farther. And I said, I may just have to accept the fact that valuations are going to be a little extended for a while.
So let's talk about something that I brought up on Fast Money. And on TV, you don't have a lot of time to sort of get into the nuts and bolts. That's just the medium. We have a little more time to discuss it. What I said earlier this week was there are a lot of people out there that arrive at a number that they want to get to. For example, I want my target to be 6,000 in the S&P, and then they do the math, they do whatever histrionics is required to get there. That's not what you do. You do the math, you do all the work, and whatever it says it should be, that's what it should be. So it's in terms of what you're doing, it's a very quantitative process, and the numbers are what they are. You just said before, you believe in and you trust the math. So walk us through that a little bit, because the math doesn't lie.
Yeah, look, and look, I would also say that the other thing we've been talking about a lot with our process lately is these targets are a compass. They're not a GPS, right? They sort of give us a way to structure our message about where we think the market is headed. And working through all the numbers, working through all the math helps you make sure that certain things make sense. And by the way, if your numbers aren't matching up with where the market is, maybe you're looking at the wrong numbers, right? You need to go back and sort of do that thinking. So it's all about sort of the framework and the process. I think sort of core to my belief of investing is there's not just one magic bullet, right? There's not just one thing. It's not always valuation. It's not always sentiment. It's not always liquidity. It's not always earnings. This drives my buy-side clients crazy, but when I say this, but it's not always fundamentals, right? It can be other things. And so we have basically what we're doing right now are 5 different models that go into the targeting process. So the first of those is sentiment. That's one driver. The second of those is the economy. So we have a GDP test that we bake in. Another one of those is our new valuation work. That's kind of the new entry into the list. We've really revamped that a couple years ago. Then we also have a cross-asset model. Not my favorite. I'm an equity person, not a cross-asset person, but we do have to look at that angle. And then the last thing we look at, which I would, argue is debatable whether it should be on the list, but I find comfort having it there, is we have some political tests.
Right.
And the content of those may change, and I'll tell you what I just did with this mid-year outlook. Everything back in January and even in the March refresh had been based on looking at a 12-month forward or a full year look. I tried something new this time and said, I'm going to replace all that with second half type stats or 6-month forward stats to just say, hey, look, the first half happened. This is where we are. Given this starting point, where do we go from here? And so, if you look at my sentiment model, AAII net bulls, we're at a level, we're close to exiting that level, but we're at a level that says, we should have about a 4.5% gain on average over the next 6 months. So we bake that in.
And that's been giving you a little bit of, I don't want to say discomfort, but it's right on, that number is right on the precipice of going through that one standard deviation. And it's been right below it, which is sort of, has you sort of on the edge, I guess.
Right. And I will tell you, when I was writing the outlook, I was struggling with that, right? Because on the one hand, I look at this chart and the one standard deviation mark, I think, is around like 22% or something. And we had a couple weeks where we popped up to 21 point something. And the average is still, at the time we wrote this was still like 16, 17. So it had a little distance. But I've been watching that chart for months, and I'm like, this thing is about to go over the one standard deviation mark. And that's what it did last August, and that's where it was this March before we got the pullback. And so, you sort of sit there and say, it's going to go there any minute, right? And so if I move a target up, are we going to hit that sell signal? And I just watched it and watched it and watched it. And I said, I've got to be intellectually honest. We're hovering right below it. You can still have some gains. Once we get above it, it's signaling on a 3-month basis kind of a flat market. We'll deal with that when we get there. We know it's coming. We're keeping an eye out for it. And that's where I sort of came up with, I'm a nervous, jumpy bull, right? I see very clearly on that model, there's a little more room to go. There's not a ton of room left to go. And, I'm not sure what's quite going to take us to that high, but we have to be prepared for a pothole when we get there.
Well, let's talk a little bit more on sentiment. So you just mentioned AAII, and again, that's a very institutional sort of survey, isn't it? Right?
That one's the individual investors.
Okay.
Although I would argue that individual investors, are more like quasi institutions these days. I mean, so much money is professionally managed.
Right.
But
well, let's talk about hedge funds, right? And
yeah.
so they've gotten massive, and they're long short. They're running kind of small nets. But when you think of, I just kind of track it like the folks that come on CNBC, and we hear, they're all in on AI, right? And so, the stories are fairly concentrated, let's call it, or, 10 names or so. But those 10 names, what's the number, guy? $10 trillion in market cap or so. And they're driving a lot of that earnings, right? Like the earnings growth. And they're driving, obviously, a lot of the market gains here. How do you think about hedge fund positioning right now? Because it seems like they're all in, but this is a sort of group that can change their mind fairly quickly.
Right. And it's, I definitely see, especially in Fed conversations, the hedge funds are sort of constantly changing their minds and just flip-flopping, from one extreme position to another, right? So I do think they're responsible, for some of these, kind of quick moves and some of this churn that we've been seeing. When I sort of think more, I brought it out just a little bit beyond just hedge funds, but the institutional side, I like to look at the CFTC data. And what's interesting there is if you look at net positioning on a dollar value basis and just across, all of institutions, right? So that would be hedge funds, that would be family offices, pension funds. What you generally see across that data right now is in the aggregate, U.S. equity futures positioning is hitting new highs. It is above where we were in January 2018. It is above where we were in February 2020, and it's been above every peak that we've made post-COVID. So it's a scary chart. When you dig down, though, you see some of those nuances you mentioned, right? So S&P futures positioning for the 500, the big cap, hitting new highs. NASDAQ 100 futures positioning, hit new highs, fell down. Now it's kind of going back to those right now. Another one that says a little more room, but not too much. Look at Russell 2000 as a proxy for like everything else. Right. You're not at, kind of recession or growth scare type lows, but you're at SVB lows. And that was a pretty, sort of negative dour time for small caps. So you can see some extremes within that data on opposite sides.
What is the problem, in your opinion, with small, measured however you want to measure it, RTY, IWM, whatever it is? Maybe they're not the best constructed ETFs, but they're out there, and they've clearly underperformed. I mean, these things made a prior high probably a year and a half, 2 years ago.
So I think that small caps are in a little bit of a pickle. First of all, if you look at Russell 2000, the percent of companies with negative earners is about the highest it's ever been, right? It's getting really, really extended. Put that issue aside for a moment. I will tell you, we look at S&P 600 as well. Valuations are pretty cheap in both of those indexes. S&P 6 is a higher quality version of small cap. So it's a problem for stock pickers, but it's not, sort of the ultimate issue here. I think the problem is that we keep playing this Fed game. I don't even know what to call it, but let's take any typical CPI print or Fed meeting, and you're going to see the hedge fund community take the most dovish interpretation they possibly can of it. And then I start getting questions about whether or not it's time to buy small caps. What you have to do is look at the history. The history says that small caps do tend to get a pop after easing starts, but it's after easing starts.
Right.
It's not before. It's not even instantaneously with when the easing starts. And that's because they do have dicier balance sheets. Those balance sheets are much better than they've been in the past, but they still have, short-term issues that they've got to deal with.
So a lot of folks kind of hate any comparison to a prior bubble, right? And again, I think what's going on here is at least a sentiment bubble around a very concentrated group of stocks. And when I look, and I'm not asking you to go one by one here on the sectors, but if I look at, let's just say, everything outside of tech, you just talked about small caps. If I go to real estate, if I go to materials, if I go to the XLE, which is obviously energy stocks, I mean, the XLV, which is healthcare. I mean, the list goes on and on, and on. They're all underperforming the massive, like S&P 500. So what does that say to you? Because to me, it feels very much like late 99, early 2000, because a lot of things, I get it, the stocks, the companies, they're very different in what's going on here, but sentiment is not that different. It's, in every market cycle, there's excitement, whether those companies had real earnings or they didn't, whether they're going to go out of business and drop 85% over the next 2 years in a long bear market. It just feels to me that large swaths, at least of the, investable equities, are not performing particularly well.
No, and look, I think it goes back to what has everybody in such a bad mood these days, right? Because I forget the stat you mentioned, but however much we're up so far this year, right? People don't feel good.
S&P 500 is
right.
up nearly 18%.
Right, and it doesn't feel like that, right? I mean, it feels more like that 5%. And I think the reality is people are still having a hard time understanding sort of where we are in the economic cycle. And there's, less recession fears out there, but if you just look at GDP forecasts, they're stuck. And where they're stuck for this year has been around 2.3, 2.4%. That's a touch under average. Average since the late 70s is about 2.6. For next year, they're stuck at 1.8. So economic growth, I mean, we've seen such an upward revision from last year, but it's still not to kind of hot levels. And when you're in a cool economy, below average, people cling to secular growth stories. Mm-hmm. And it's really what we've seen for both small versus large and value versus growth. You need to get GDP growth up above that average level to really have a sustainable trade. And so we've seen at certain periods when you've really moved the GDP forecasts up, that's when this rotation trade seems to catch a bid, and then something comes in and slams it back down. Right now, what's slamming it back down is everyone's worried about the consumer. And I've told people on this rotation trade, I am so sympathetic to the impulse. Growth is getting crowded. It's expensive. I'm kind of a value investor at heart anyway.
Yeah.
But the conditions are there, but you need the trigger. And that trigger, we keep getting head fakes. And I just don't see that rotation really, really starting unless people really get that economic confidence back.
Right. And if you're worried about the consumer right now, you also have to be worried about enterprise spending, because right now it feels like it's been as good as it could possibly, be. And Nvidia, selling all these chips, right, to all these other companies, the other trillionaires, whether it's, Tesla, or which is almost getting to $1 trillion, right? But it's Amazon, it's Google, it's Microsoft. I mean, the list goes on and on. And so if you have a consumer that's weak and weakening, okay, you have GDP growth, which is expected to be 1% over, next year, as far as that's concerned. If these companies don't figure out what the business models are, what the monetization is, think back to Meta. They were talking about the year of efficiency. They cut a lot of jobs. Tesla cut a lot of jobs. Almost every major tech company in 2022 into 2023 were cutting a lot of jobs. So I just kind of worry that, we're kind of whistling past the graveyard here, because if there is a consumer slowdown, it's going to go to the enterprise. We're going to see job cuts. We're going to see CapEx cuts. And I just feel like that cycle, given the valuations, is not a great setup right here for stocks.
Right. And I feel like we're going to be okay in the end. It's almost like we're driving through intense fog, and everything's probably going to be okay on the other side. But the intense fog, when you're driving through it in the middle of the night, just doesn't feel so good. And I feel like that's kind of where we are. And to your point on the corporate side, as I was going through the last reporting season, earnings transcripts, there were a number of sort of business services type companies I was reading, and they talked about the paralysis and the delay in decision-making from their corporate customers. And it's not that they were losing deals. It was just taking their customers a lot more time to figure out what they wanted to do. So you could just see that sort of fatigue and hesitation sit in. Now, I will say generally in the post-COVID environment, the economy, consumers have been underestimated. And I'm not convinced the consumer is breaking in here. I think the consumer is mad about inflation, and like my kids, is acting out a bit about it. I think, and by the way, I'm right there. I mean, we were talking earlier, I bring my lunch to work now, so I get it. But, I think we've got to work through this. And so, when we were setting the target, 5,700, I wasn't trying to manage to that, but that sort of feels like the right answer, just given what we're going through economically.
Right, indulge me for a second. Where did you grow up?
Alabama.
Yes, you did. Have you ever seen the movie Days of Thunder?
I don't think so.
Of course not.
So Robin is racing. She's not
Rubbing is racing.
Is that where you're going?
Well, not necessarily, but you mentioned we're in that period of fog right now.
Yeah.
When we get through it, everything's going to be okay. But
Yeah.
getting through it is scary as shit. And that's what happened with Cole Trickle as he approached the turn. He had to get through all the smoke.
It wasn't fog, but it was smoke.
It was similar.
Yeah.
I'm surprised. You should really watch that movie. Robert Duvall's in that movie.
He was great.
I mean, anything with Tom Cruise is great.
That's where Cruise met Nicole Kidman, I think.
I don't think that's true. They did
really?
a movie before that, Ireland movie that they did.
No,
before.
they did that afterwards.
They did that after?
Yeah.
Oh, whatever.
Yeah. Far and Away or something like that.
Far and Away.
Yeah.
Amanda's screaming at me right now.
That's fine.
So I'm going to throw a couple things at you, because you mentioned the jobs market. And I think, and I've thought this for a while incorrectly, but it seems to be going that way. I thought people will be surprised by how quickly the unemployment rate starts to go higher. And we're starting to see it on the margins without question. You sort of look under the surface of the jobs number. It's not as healthy as the rate would make it appear. In your work, I know there are a lot of variables. How important is that one?
So I think it does matter. I think it gets very complicated very quickly, right? Because labor market weakness seems to be something the investment community thinks you need to see before the Fed will cut. And so the question is, what is the market going to respond to more? Excitement over the cuts or the deterioration in the labor market? And I think probably the cuts win the day, as long as the deterioration is not too bad. And I think that's where my head is. I also tell you, if you go back and look at small versus large over time, the pivots in small cap where they start to outperform actually have some proximity to upticks in the unemployment rate.
Which makes no sense. I believe you.
Yeah.
But it's completely counterintuitive.
It's the most confusing chart I've ever seen in my career. And I actually stumbled upon it back in 2007 when I was launching in small cap back at Citi. And it took me a while to figure out what was going on. And what you really understand is that you see small caps underperform late cycle, right? Heading into the recession, heading into whatever, sort of mess you're going into. And you always want to buy small caps midway through a recession. So that labor market weakness tends to be, sort of confirmation.
Some sort of, right. The thermometer gets to a certain level where might not make sense intuitively, but I do get it. Let me ask you the next question, because you also mentioned this being a presidential year. That factored into your work. And I think it's one of the things that I don't want to say concerned about, but you're paying attention. And again, it's not about politics per se, but it's about what they could potentially augur for the market.
Right. And I think, we've got a lot of noise going on, right, in the political world right now. There's a lot going on. And my job is to sort of step back from that, right? And I have one chart, or one set of charts rather, that look at sort of the seasonality around how the market trades in presidential election years. And if you go back and look at 2016 and 2020, so the Trump win and the Biden win, pretty much the same pattern. Obviously different degrees of magnitude on the downturn, but you do normally see, kind of before you get a lot of clarity on who's going to win and what the candidates are all about, the market tends to have a sell-off. And then it rallies back, peaks out a bit before election day, gets choppy around election day, and after the event passes, you rally back into the end of the year. The one time that didn't happen was back in 2000 when we didn't have a clear winner. And so you hear a lot of people talk about this. As long as we have a winner, the market should be able to work through it. I think there's a lot of truth in that based on what I've seen, because I've gone back and looked at all these individual presidential election years the past couple decades, and they're mostly in line with that pattern we saw in 2016 and 2020.
Newsflash, we might not have a winner declared in this one either. So it might be interesting to see 25 years on.
And I think, from my perspective, right, it's a tail risk to be concerned about. But when I'm putting out a forecast, you can't just bake in the tail. You have to be monitoring the tail. You have to be really mindful of it. You need to be watching for it. But I think that's where, someone in my seat could get into a lot of trouble.
Let's talk about tail risk because, we remember, the bear market of 2022. It was very orderly, right? In many ways, and was pricing in the potential for a recession in 2023. Most market participants were fairly certain that we were going to have a recession. It was kind of the hangover effect of the COVID and, in the like here. And there was a lot of excesses, right, in late 2020 into 2021. So there needed to be a bit of digestion. So the recession never happened. And, this generative AI thing really got things going, even despite Silicon Valley, right, in March of 2023. So what do you think the tails are? We had a war, a breakout in Europe. We had inflation. We had supply chain disruptions. We had China pretty weak. Geopolitically, there's a lot of stuff going on, So what do you think the tail risks are right now? Because U.S. investors don't seem particularly worried about any of them. And I guess we've already learned this over the course of our careers. There's very few things that disrupt a raging bull market like we have right now.
Right. And I think, I started in the business back in 2000, right? So, 9/11 was one of my formative experiences, and I lived through the GFC. And look, I think what I've learned over time, right, is you very rarely can figure these things out. And, when investors sort of send around their little lists of tail risks, those things never end up happening. And the fact that people are worried about them means they're already priced in to some extent. So I do think it's truly unforeseen events that have the power to shake markets, or just, a flat out recession scare, right? I would say the one thing that, as I sort of put this mid-year outlook together, and when I think back to January, I was thinking about it as well, the whole idea that inflation is going to continue to moderate, right? Like that is baked in throughout my forecast, to the valuation model, to the earnings model. It's just underpinning a lot of different things. And if you go back and look at periods, right, like the 40s and the 70s, inflation would go up and down and up and down and up and down. So you had a lot of head fakes. And I think that's a mindful thing to be worried about. And especially in these Fed discussions, I see all this eagerness out there for the Fed to cut and do it soon. And I get it from a labor market perspective. I get it from wanting to avoid the recession, but I also truly understand, having looked at the history, why they want to be careful and make sure they've beaten inflation.
Well, the history, and I think the one history they're looking at is probably the early 1970s, and I think they want to be extraordinarily careful they don't repeat the mistakes made, because, Arthur Burns, he is remembered for that period of time and that period of time only, and that sort of put a real, blemish on what was a pretty amazing career. With all that said, let me ask you this, and we talked about this prior, we've talked about it before, but equity analysts can change price targets seemingly every other day, and there's no real ramifications unless they completely miss the boat on things, which happens from time to time. For whatever reason, strategists, people in your seats, when you change your price target on the S&P, whether it's up or down, there's always some consternation surround. Why do you think that is?
It makes people really mad.
Well, but it's interesting though.
Yeah, and it's interesting, right? The sell side does these targets, the buy side generally does not. And the roles are pretty similar, right? And it's interesting. I view it, and again, I've done this a long time. I've worked for a few different strategists. I've been in the lead seat. I've also, done the job without having a target, right? And I will tell you, what I like about having a target is that it makes me go through and, again, just really think about all those drivers and what are rational numbers. You always have to figure out the starting point, right? Like that's the hardest thing. You have to make sure you're looking at the right test, but it really forces you to think about, if the market's going to keep going up, why? If the market is above my target, Am I looking at the right things, right? I think it gives you a discipline and a process to look at. And I know it's difficult right now, with all the concentration, but we have had concentration spikes before. I'll also tell you, I mean, I know it's different, but back in the 2000s, there was one company that wreaked havoc on all of our models, and it really caused a lot of problems. So these things happen. But I do think in general, our job, the same as an equity analyst, new information comes in. You need to update your models. You need to update your numbers. Nobody in this business has a crystal ball.
All right, let me ask you this real quick. Dan, I don't want to jump in, but there's also a way to get the S&P target with two numbers, and those numbers are what multiple am I going to give earnings, and what are the earnings going to be? And that's sort of the back of the envelope stuff. My sense is you probably look at that and are interested by it, but that doesn't really play a role in what you're doing. Is that accurate?
It's one of the 5 tests, and I would say over, the last 5 years or so, I've just really developed the models there. So for earnings, we have an income statement. And people like our model, right? We model out revenues. We've been very frustrated in our attempts to model out margins. We write about that. We're very honest about that in conversations. We model out interest expense. We make assumptions on tax rates and buybacks. And those are kind of the nuts and bolts of that model. But so I look at it, I do think the kind of focus on strategist EPS forecast is interesting, because if you look at the bottom-up consensus projections, those generally start out, on years that they're cut, end up being about 10% too high. By the time you get to June or July of the year in question, they're basically in the right neighborhood. Maybe they move 1% or 2% through the rest of the year, but management teams are really good at making those estimates, at least for the S&P 500. So I do model out earnings. I do think you need to really pay attention to the bottom-up consensus. We wrote about that in this mid-year outlook. And then on the valuation model, I don't spend a lot of time looking at competitor research. I'm not quite sure what people are doing to come up with their assumptions. I have a suspicion a lot of people are doing regressions with 10-year Treasury yields, because I think that explains, when I've reverse engineered it, why
where
people
they get certain numbers.
Right. Last year, people kept talking about the market needs to trade at 15 or 16 times on forward PE. And I remember at the time I ran a regression with 10-year Treasury yields post-GFC, and I did a forward, I think I did a weighted median forward PE on the S&P, and it suggested you should be trading at 16 times. And I don't do that. I go back to this valuation model that looks at data back to the 60s and inflation and rates in the Fed. And, we take consensus projection and say, if you think inflation's going to be X and the Fed's going to be at Y and 10 years going to be at Z, this is what the PE should be. Multiply that times the earnings. Here's a fair value for the market.
By the way, I remember having that exact conversation with you about multiples and the environment we're in and why a mid-teen multiple might make sense. And your pushback was pretty much exactly sort of what you're talking about now, that yeah, I can understand the math surrounding it, but it just doesn't sort of line up with what you were seeing.
Yeah, so let's go back to the mega trend here. And again, I remember what the internet was going to do for the economy here in the US and the global economy. And it wasn't just, bottom left, upper right. And we had this massive bear market. You talk about you came into the markets in 2000 and you think about, the market was down 2000. People didn't think it was over, right? 2001, also pretty bad. 2002 felt the worst, you know what I mean? Because there was no hope in sight. So let's just say that, the companies that have been buying, tens of billions of dollars of these high-end GPUs, and they're building out these servers that go in these data centers, and you see how it all works, right? And so let's just say these companies find the business models, right? And you go from the training phase to the inference phase, and a lot of companies are able to use this and get more productive, okay? Let's say the Fed is right, that inflation goes down to its target near 2%. What if we have this amazingly deflationary period? What if Goldman Sachs, who half their employees are programmers, you know what I mean? What if they're able to use a lot of these models and get rid of a bunch of these 27, 28-year-olds that they're paying $400,000, you know what I mean? And so one of the things I keep hearing is that one of the best use cases is basically for programming, right now. So before the pandemic, the Fed was dying to get inflation up to its 2% target. So talk to me a little bit about the potential for a deflationary period, and what does that do to risk assets?
So look, I think there's short-term disruption, right? And my assumption is that, as you've seen with any big technological or industrial revolution, there are short-term problems, and there are, and then the labor market is disrupted. But ultimately, you recalibrate, right? And people are able to move into more interesting jobs, right? You find new ways for those people to be employed. Now, that doesn't mean it's fun in the short term. And I think I think it is something to consider, right? Because I think it's not anything we've really confronted, right? And when markets are confronted with big pockets of uncertainty like that, generally there's a bit of a sell-off.
Yeah. Would you agree, though, that the promise of generative AI is not too different than the promise of the internet? And just think about how the global economy and so many businesses have been disruptive. I mean, we can all agree that the potential, 10 years out, I just worry about the near term. And that's one of the reasons why I think there's going to be this digestion phase, whether it's in a year, whether it's in 2 quarters or 3 years. It's just it's going to be ugly, too.
I think it's in the messy period. That's the word that keeps coming up. And I thought it was really interesting to track the AI discussion in this last reporting season, because my team and we split up all the transcripts by sector and read through, and this is one of the topics we read on. And I just laughed, kind of looking at the comments from a number of financial services companies in a different, number of verticals that just kept saying this isn't even going to be a 2025 impact. This is going to take more time. So I actually, think it's good, right, that you're seeing companies admit pretty quickly this is not going to be a silver bullet that's here tomorrow. It's going to take a little while to figure out.
So, think back to late 2021 when Facebook changed its name to Meta, right? And they changed their stock ticker to Meta, and then it proceeded to go down like 70% over the next 18 months. Netflix went down 70% plus. Believe it or not, Nvidia went down 75%. The list goes on. And so I just think it's so interesting that investors have such short memories of this because, again, we can all agree that generative AI looks very different than like the promise of the metaverse, but it's not really that different from a psychology standpoint. I mean, shit was going ape shit, you know what I mean? In 2021, you think about all the SPAC stuff and the risk that was being taken. And there was also crazy multiple expansion at the time. So to me, it just doesn't seem that different. But right now, it just continues to make anybody who's cautious or bearish look like an absolute idiot.
Right. I thought what was interesting too this last reporting season, I feel like and I'm not going to say any names, but I could sort of see the companies that are doing well, right, that are the real architects and know what they're doing, and they're helping other companies develop these technologies. And as long as the build is going, right, they're going to be fine. And then you've got the others, right, that are their comments are, let's just say, not quite so robust. And they're talking about things like their online chat agents, right? And you're like, well, that's not really generative AI, right? Like, so I think you're starting to sort of really be able to separate who's really in the middle of this, who's really benefiting, who's really driving this, and who's really just on the fringes.
Yeah, but we've seen some of these stories. Sorry, Kai.
No,
I know you
no.
want to get it. Like Dell is a great example. Okay, they're building the servers that go into the data centers, and they started telling a story about 6 to 9 months ago, and the stock, just took off. Micron, all of a sudden, the most commoditized thing that you can find in any, device that has a chip, you know what I mean, as it relates to memory, joined the party, but then their guidance wasn't particularly great, and the stock sold off. So we're starting to see some kind of kinks in the armor a little bit. And I wonder as we get into Q2 earnings and Q3 guidance, whether that becomes that much more prominent. And we had that same sort of thing that happened last July, 2023, and it went on for a few months, right, into the lows in late October.
It feels like you're hovering around a top. It might not be a tippy top, but if you look at, just take the Mag, and I know it's not exactly analogous, but you take the Mag 7 and you look at their earnings growth, and the differential versus the rest of the market last year was about 40%, right? And now that's shrinking. And in 2025, it's expected to be like 2-3%, right? So it's losing its earnings growth advantage. You're seeing these massive growth rates start to decelerate. There's not a lot of room for error when you're in that kind of environment. I think that's what we're in now. There's just not a lot of pain tolerance in here.
You mentioned driving before. Do you drive? Are you the driver in the family?
I do drive now. I will say I went through a stretch of maybe like 15, maybe more than that, years where I did not get behind the wheel of a car after moving to New York City. But my kids have forced me to learn how to drive again.
Understandable, by the way. And I don't know if you've ever been on the Cross Bronx Expressway. It's a nightmare. I mentioned this because in your note, it mentioned potholes. And you can hit a pothole every once in a while. You say, it's shit, but you keep going. Other times you hit these things that are like craters and your car stopped on the side of the road for a while and you're stuck. What kind of pothole Because again, that's something that and I don't disagree with you, but is it just one of those potholes that's sort of shit, or is it one where you're waiting for AAA to come get you?
It's not quite in the latter camp. I mean, what I had in my head when I was writing that was the potholes you kind of go through on the FDR when you're, I live downtown, and you go up and like you're just powering through and you just keep going, but it doesn't push you off and you still end up and the car's not damaged, which, in stock market terms, I think is more like a 5 to 10% drawdown. Anything, it feels like it needs to be worse than April. I just don't think 5.5% didn't fix any of our problems. But more than 10%, at least in my career, that is synonymous with a growth scare of unfurling. And again, I think what we're going through with the consumer, I think we're going to come out okay on the other side. It's not going to be pleasant while it lasts. But I don't really see us going into even like 2015, 2016 growth scare territory. But again, going back, nobody has a crystal ball. If we see things on the ground that suggest that's changing, we'll adjust accordingly.
That's why we admire you, and that's why you're always invited here, Lori Calvasina. Your work is extraordinary. Thanks for joining us yet again.
Thanks for having me. This was fun.
Thanks, Lori.